Hi, everyone. This is Dave Levine with Trickle Research. Today we have Corey Ruttan. Corey is the CEO of AlvoPetro. I think those of you sort of follow the YouTube page and some of these Dave has a question videos, you probably know that Corey was the first, so it was sort of our guinea pig. We made him go first. And now I just feel like there's been so many things going on with the company that have been really, really positive. And while I think the stock has responded a little bit, I really don't think it's responded the way it should have. And so, I felt like maybe it made sense to have Corey come back on and touch on some of the minutia of what's going on here. Just to recap for everybody, that they've been working on getting their resource in Brazil into the sales pipeline, and they did a lot of work to establish the infrastructure to do that. And I sort of feel like after that happened, everybody sort of, there was like a sigh of relief that they actually did that part. And I'm not sure that along the way, maybe everybody's completely understood some of the, as I said, the minutia of this, and more specifically, and I think that I'll sort of pose it this way, and then Corey, you can kind of answer them in this order. I mean, there's really been three, I think, really big catalysts to this story. It's setting aside that you've transitioned to, revenues and profitability and cash flow and all that great stuff. But on top of that, some really important catalysts that I just don't think have been understood very well. And, just kind of put them in order and then let you talk about them. I mean, one of them is, we've seen a pretty significant increase in resource prices, energy prices. And those are things that, because of the way that your, pricing arrangement is laid out, they're things that as we move forward, presumably if energy prices stay sort of in this range, those are going to be things that lead to higher energy prices for your product, which is just kind of additive to, margins almost directly. I'm not sure why that's necessarily hard to understand. Maybe the pricing mechanism is a little hard, so maybe you could touch on that. I think the other thing is that, one of the things that has been kind of a missing piece in the story has been your ability to sort of replace or replenish your resource base. You had a very topical announcement regarding your GOMO resources here, not just a little while ago, that I thought were very constructive in terms of that issue. And then I think you also reported some production results that were better, certainly than, somewhat better than what I had anticipated. And I guess I hadn't really sort of thought about production results being maybe better than kind of this schedule we'd kind of laid out, just because of kind of the arrangements along the way. So I guess if maybe you could just, in any order, if you can remember all that stuff, if you can kind of address some of those things and see if maybe we can kind of provide a little bit of clarity on why those things are so important to the story.
Yeah, no, thanks, Dave, and thanks for having me on again. Yeah, well, maybe stepping back to talk about the production first, because it's probably the even the most transparent thing. I think, if you remember way back in time, our original terms under our gas sales agreement were such that, the firm volumes translate on a barrel of oil equivalent per day basis. They were actually less than 1,000 barrels of oil equivalent per day. We brought our project on stream July 5th of last year. Our very first quarter of production was actually close to 1,800 barrels of oil equivalent per day. In the fourth quarter, we posted 1,950 barrels of oil equivalent per day, so up 11% from the third quarter. And then just Tuesday of this week, we announced our first quarter results from 2021. And that was just shy of 2,175 barrels of oil equivalent per day. So it's up another 12%. And it included a disclosure around our March production, which was just shy of 2,400 barrels of oil equivalent per day. So when you compare that back to kind of the early days of kind of the firm portion of our contract, I think we've been really exceeding expectations quite considerably there. In mid-March, we announced our fourth quarter results. We had funds flow from operations of $4.3 million US for the quarter. And I think with the production increases we just talked about, we're pretty nicely positioned to post, I think, another good quarter of results here for the first quarter. And then on top of that, you touched on this, but our price mechanism resets every 6 months. So on August 1st of this year, we're also expecting a nice uptick in our realized gas sales price. And further to your question there, just maybe a little bit of detail about how our contract works. Remind you, we have 3 different international benchmark prices that get blended together to create our gas sales price. So it's just over a third Henry Hub gas, 40% Brent oil equivalent price, and 25% NBP, which is the National Balancing Point gas price in the UK. So you blend those 3 things together. Like I said, it gets reset every 6 months. You average, there's a time weighting mechanism. So the way it works, in August, it'll be the first period of time where we have the prices from the first half of this year, and half of the formula will relate to those benchmark prices for the first half of 2021. 25% of the price will relate to the benchmark prices from the second half of last year. 12.5% will relate to the first half of last year, and so on and so forth. So, what in effect happens is there's much less volatility in our price. There is a little bit of a delay mechanism. So some of the recent increases in pricing that you've seen will really start to realize that in August. And, even if we stay at flat prices today, we're expecting a pretty decent uptick. When the price does get reset every 6 months, it's in local Brazilian currency per cubic meter, which is currently it's $1.06 per cubic meter. That, again, if benchmark prices stay flat, should increase by about 18% to about $1.25 per cubic meter. And at current exchange rates, that translates into US $6.13 per MMBTU. And then when you adjust it for the heat content of our gas, it's almost $7 US per MCF. So pretty attractive price. The last, I think, really unique thing about our contract is we do have a floor and a ceiling embedded within our contract. Those also get reset every 6 months based on US inflation. At current inflation levels, the August floor will probably be about $5.35 per MMBTU, and the ceiling will be about $9 per MMBTU. So the last point to make there is, given that our first year of production will have effectively been at the floor pricing within our contract, it's really unique that we've got this asymmetric exposure only to kind of price increases from this point forward. So, hopefully that will be something that's positively received as we move through the year here. And then, you asked a lot of questions at the beginning, so I think.
Sorry. Okay. Yeah.
No, we've had a lot of news that's come out over the last 2 months, and one of them you talked about the GOMO project that obviously we've been working on for quite some time. Now that we're producing gas, we've got our pipeline and our gas processing facility up and running. We're now well positioned that we can go and capture the upside that's been always embedded within this opportunity. And now we've independently quantified that for shareholders to try to give a better sense for what the size of the prize might be. And if you recall, we completed a longer duration test on our existing 183-1 well earlier this year. We made the final investment decision on a pipeline extension to extend our current pipeline network to tie that well in. We expect to have that pipeline completed by the end of the year and have that well tied in for production. As a result of that, we did book 2 kind of fit for purpose development locations in our proved plus probable reserves this year. And when I say fit for purpose, that's with an optimized drilling, completion, and stimulation design. On top of that, the area close to the reserve area that we booked, we had an independent assessment of the contingent resource associated with that. And then on the part of the geobody that we can map on 3D seismic that's a little further away from that, the evaluators booked what's called prospective resource. So you kind of can combine those three things to try to get a sense for what the size of the prize might be. You know, on a, you know, if you look at the risked resource, recoverable resource potential there, you know, just to very simply put it in perspective, it could potentially be about 3 times larger than our share of Cabaret. So our Cabaret reserves are just over 6 million barrels of oil equivalent. And on a combined basis, you know, it's over 3 times that on a developed basis there.
Okay, and so just so we're clear, is it reasonable then for us to assume that you may be selling Gomo gas sometime in the first half of next year?
Yeah, our target is actually to be selling gas from the existing 183 well by the end of this year. We're working through the design and timing for actually drilling that fit for purpose well. You know, we'll talk about the exploration catalysts that we've got coming up, but we'd like to get those finished first, and then we'll make our capital allocation decisions between the exploration wells if we have success and or the Gomo project. But you'll see continued investments there probably through next year.
Yeah, so the expectation is that you know, as you move forward, you know, you'll continue providing exploration updates that at some point, I guess if everything goes as we hope, that you'll end up with, again, a resource that's, you know, three times what you have at Cabaret. I mean, so we could sort of look at the year from an exploration perspective, certainly potential for catalysts around the additional proving up of that resource.
Yeah, and I'd like to separate the exploration results that we can talk about on the wells coming up as kind of a separate thing, and I would call that conventional exploration. And then I think completely separate from that, I would say, is our Gomo tight gas resource. And the nice thing about the Gomo part piece of the puzzle is that with success here, as we, you know, for example, if we drill the 2 development locations that we have booked in our reserves, then it potentially helps us migrate the contingent resource into reserves, and at least part of the prospective resource into contingent and then reserves. So it's like a conveyor belt here that with activity creates a very nice way to replace and replenish reserves and production. And then on top of that, we have you know, the exploration catalysts that are coming up.
Yeah. Okay. So to put it, maybe to simplify it, maybe from a perspective of kind of where we were, say, when I initiated the coverage, you know, just kind of where we were, let's say a couple years ago. I mean, Gomo today is certainly has more visibility with respect to production than it did then, or even a year ago. And I think certainly now when we talk about Gomo, we really are, at least some portion of it, talking about an asset that is going to add to production, which is not something we could talk about a year ago.
Yeah, and that, you know, if you recall, this is exactly what our plan was all along. So we drilled these wells quite a while ago. You know, although they're lower deliverability wells, they have a very long reserve life. But to kind of have the confidence, I guess, to be able to make the types of investments we did in the pipeline and the gas processing facility and all that, we needed a more conventional resource to underpin that. So the nice thing is the Cabaret project that we brought on stream last year has basically completely underpinned all those investments. And now, just like we said, once that's all done, we can now go back and unlock this potential that we always saw in the Gomo formation. We now just you know, quantified it, and it's more real because we're actually building a pipeline and we're going to have a well on production here. So it's nice to be in that position. You know, if you look at the number of locations between reserves, contingent resource, and prospective resource, you know, we have an inventory of, you know, potentially roughly 16 development locations that we can be drilling into that over the coming years.
So, yeah, I mean, again, I don't always know, what people understand or interpret about what you're doing, but I really feel like the last, even 90, 120 days, you provided really a pretty compelling amount of visibility on some of the things that we were kind of wondering about. And certainly that, GOMO and potential, ultimate production and ultimate increase in resources, and those things are certainly one of those things. So, so let me sort of segue that into.
And maybe if I can just add one thing, Dave, to try to help put it in, you were asking, how do we try to quantify or put this in perspective? Another way to look at it, we've got a slide in our current corporate presentation. On an unrisked basis, if you layer on reserves and the two different categories of resource, on a developed basis, it translates into roughly 3,000 barrels of oil equivalent per day of gas and condensate production, which again contrasts that to what we've been producing lately at around 2,000 barrels of oil equivalent per day.
Okay, so and I know that this is a little bit translate that into, again, what we sort of used to talk about and we still do. You still do, obviously, in the slides and things, but maybe to bring this up to date a little bit. How does all this translate into eventually paying dividends from the project? Has any of that perspective really changed? Or because again, from my perspective, I sort of look at this story and go, well, if you want to look at this from a really, really long-term investment perspective, I mean, I think what I argue to people is that here's an opportunity to buy a stock that's inexpensive on the face, but if you start paying dividends of the type you're talking about, the return of that dividend relative to today's stock price is really extraordinary. So can you talk about that a little bit, just sort of the prospects?
Yeah, no, absolutely. And what I might do first, Dave, just because it segues into that nicely, is just to talk about the exploration catalysts that we have coming up here. So, we've been talking about these two prospects for a little while now. We've contracted a rig. They're doing upgrades to the rig. It's should be ready for rig acceptance no later than May 18th, and then we would move it to location, pressure test it, rig it up, all those things, and be in a position to spud the first of those two prospects in early June. The first prospect is called 183B1. So again, this is different than the GOMO. These are conventional exploration prospects that with success would look a lot like Cabaret probably. So we had them independently assessed by GLJ, just like we did the GOMO resource. And on an unrisked prospective resource basis, that first prospect has unrisked recoverable resource of 5.9 million barrels of oil equivalent. So very similar to our share of Cabaret. They assigned a 44% chance of success to that. And then what we'll do is once we finish drilling that, so probably, towards the latter part of July, we'll have results from the first well. We'll move that over to the second well and spud that. It'll take a little less time. It's probably 7 to 10 days to move, and then another, close to 40 days before we have results from the second well. So that would be, in September sometime. The second prospect, which is 182C1, has a similar kind of unrisked resource potential on a best estimate basis, again, of 4.6 million barrels of oil equivalent and a 48% chance of success, again, independently assessed by GLJ. So the reason I bring that up is, the first thing we want to do is get those wells drilled so that we have a good sense for what our capital allocation decisions from a capital expenditure perspective, what does 2022 look like from that perspective? And those results will be important to that decision. The second thing that we're doing is and we've talked about this for a bit, is we're looking to refinance our existing credit facility, to do two things: reduce the interest rate so that it's more reflective of a production stage company like we are now, and then secondly, extend the maturity. And at the end of that, we'll have much better financial flexibility, much better position to allocate, parts of our cash flow to the dividend stream as opposed to an accelerated debt repayment, which, we've tried to conservatively reflect that in our current presentation. But this goes to your point, and it's hard for me to pinpoint exactly when we're going to start and what the quantum of the dividend will be. But, those two key pieces of the puzzle will unfold here over the next 6 months, and then we'll be in a pretty good position. And I think you're right, between a multiple of cash flow, between a valuation relative to reserves, or ultimately a valuation as a function of dividend yield, I think it reasonably points to the share price being higher than it is today.
Okay, so just so I understand that, so we did, I think, as we moved along, maybe the dividend schedule did get maybe pushed out a little bit further as a result of maybe part of it just being kind of things taking a little bit longer than maybe we'd originally anticipated. I don't like to say that because I know that going into that was always sort of a moving target, and there were things you could control and things you couldn't control. So I don't even like to say it that way. But again, but certainly some of that is the accelerated repayment in terms of the timing of dividends. So if I'm hearing you right, if, for instance, you put out an announcement about a new credit facility that addresses all those things that you just talked about, better terms, something more commensurate with somebody who's producing and generating cash flow, that might be the sort of thing that could ultimately accelerate the payment of a dividend. Is that fair to say?
Yeah, no, exactly. Yeah, and I think there's three things, Dave, and I think, that's a fair commentary. We were a little later than we wanted to be. I think in the whole scheme of things, it was pretty close. We were reliant on our off-taker being finished their portion of the project. So as soon as that got done, we started production and cash flow. But yeah, it was a tiny bit delayed. Also, what happened is benchmark prices did decrease a lot, partly due to COVID, et cetera. So we were talking about prices at our floor in our contract for the first year.
Right. Yep.
Those two things combined did have a bit of an impact. But then we did absolutely recharacterize that so that we very conservatively showed 100% debt repayment literally by the middle of next year, well in advance of the maturity date of that loan. So, those were the things together. And I think you're right. The first piece is the debt refinancing, but the second one is, we still want to get these two exploration wells drilled first, and then have a very clear picture of, to be clear, what we've always said is we want to take half of our cash flow, reinvest it in growing our business, take the other half and return it to stakeholders. And what we're talking about is the other half. How much of that can we balance between debt repayment and interest versus returns to shareholders, and the timing of that. So, I'm confident that we've conservatively depicted the timing within our corporate presentation, but that'll ultimately be a decision of the board. And I think, like I said, we'll be in a very good position to make those decisions later this year.
Sure. Yeah. I mean, I guess I hadn't really thought of it that way, but yeah, I mean, even so I think if I hear you, what you're saying is even the notion of higher energy prices might be the kind of thing that, because that sort of would change some of your just assumptions about even whether it's capital or even debt repayment, some of those things. Just the prospect of higher energy prices might be the sort of thing that could, I guess, conceptually, accelerate a dividend. But then that makes sense, I guess. I hadn't thought about that, but yeah.
Yeah. No, I think, a nice uptick on the price in August, and then hopefully that will continue forward again with the February 2022 redetermination as well.
So let me ask you one last question, because I don't know if this has been maybe in the back of people's minds as they look at the story, and I think it's hard not to look at this issue kind of across the globe. I mean, we were just talking before we jumped on here, just kind of the issues of COVID and some of the things, the impact that's had. But, you know, I know that Brazil has had some issues with COVID. And so I'm wondering if you have any sense of how that's maybe impacted their energy sector or their, you know, just Brazil in general, and if that's topical or not topical to AlvoPetro, I guess.
Yeah, no, I certainly think it is. This situation is unfortunately, you know, when I tracked this roughly a couple weeks ago, I looked at it, and on a per capita basis, the experience actually wasn't that different than the US. The difference is the US is obviously improving quite rapidly. The situation is a little bit much more murky still in Brazil, so it's hard to predict exactly where that goes. You know, and hopefully we're rounding the corner here. You know, we feel very fortunate we were able to get our project on stream during all this. You know, I think one of the really interesting things is you know, our gas price, although it looks, you know, pretty attractive relative to US and North American gas prices. You know, Petrobras's price resets here on May 1st, and it looks like our price is going to be about 38% lower than what Petrobras charges the distribution companies and ultimately the end consumers. So, you know, cheaper gas like we're providing into the market is actually a very positive thing during, you know, especially at a time like this when you know, the economy's certainly struggling. I think, you know, one of the only things that probably hasn't gone in our favor since we've brought this project on stream is the currency in Brazil. You know, I did mention that for a 6-month period of time, our price gets locked in the local currency. And, you know, there has been a pretty steep devaluation in the Brazilian currency. And most people, or the consensus is that that's been overdone and that it's overdevalued. You know, if we see any level of appreciation, never mind the commodity price part of that we talked about earlier, you know, we do stand to benefit hopefully when that swings around here as well.
Okay, well, that's good news. I mean, I guess though that with respect to Brazil, I also hadn't really thought about the relative Petrobras pricing, but I guess that, because I was going to say, you know, if the economy there has been impacted, which certainly it has by COVID, and then maybe by extension the energy sector, it certainly hasn't shown up in terms of, you know, you being able to sell whatever, even increased production into your agreement. And so I guess that maybe the disparity between your pricing and Petrobras pricing might tell us a lot about that. I mean, that may be something where I guess it's going to be hard to envision with that big a disparity, you not being able to sell gas, or probably as much gas as you want, I suppose.
Yeah, obviously we have a price advantage. I think we have a quality advantage as well, which is a more subtle thing. But yeah, those things combined have created this ability to sell more gas than we originally anticipated.
Well, Corey, listen, I think that's all really, really great information. Like I say, I mean, I've sort of been sitting here kind of scratching my head at you know, what we're missing, and maybe feeling like I'm not doing a good enough job of telling the story to my investors, because it almost, I'm sort of grasping at what else there is left to know. So, you know, I appreciate you coming on and giving us that update. And, you know, as we move forward, maybe if we can get you on again every once in a while to do this, like I say, I feel really, really good, probably better about the company than I've ever felt. And so I think it's always good to get back on here and articulate that to people. So I appreciate your time in doing that.
Yeah, no, thank you, David. I'm happy to do it anytime. And maybe you know, the one last comment, you know, unfortunately with COVID and all this, you know, we would have liked to have taken a bunch of our long-term shareholders down to Brazil and shown everyone what we've been up to over the last couple of years. And, you know, again, pretty proud of what the team's been able to accomplish. I just want to make sure that all your viewers know, in our last press release here that we released on Tuesday, there was a link to a virtual field trip that we put on there. And I really encourage, it's about a 3-minute video. I encourage everyone to look at that and see what we've been up to over the last couple of years.
Yeah, actually what we'll do is when we post this, we'll post that with it, so it makes it easy for people. They can kind of click from one to the next. So I'll make sure I add that.
Even better. And
Right.
thank you. Thank you
Corey,
for
I appreciate it. You know, take care up there, and we'll circle back with you when when you have a few more things to talk about.
Great. Thank you.
Thanks a lot.